Okay, good morning, everyone. Welcome to the pre-retirement seminar for classified staff, pension and retirement topics. Today, we will be hearing from NYSERS. Shannon Johnson will be speaking on behalf of NYSERS. Afterwards, we will be hearing from Peter Quinn, who is with the New York State defined comp plan, or we call it the 457 plan. That's an additional investment opportunity for you. It allows you to double what you do, how you contribute to your tax deferred annuity, so that if you, for example, if you already have a tax deferred annuity with TIAA and you're maxing out, and you want to contribute even more pre-tax earnings to a tax deferred annuity, the 457 plan is a secondary option for you. The two amounts are not coordinated, which means that you can max out on both of them and they don't conflict with one another. And so that's a really good opportunity for you to, in the last years of employment, if you could afford it, to defer as much as you can on a pre-tax basis, and that'll just give you more retirement funds going forward. So that 457 plan is a really important option for you, and we will have someone speaking from that plan. Also, we have a speaker from TIAA. The first presentation from the TIAA rep will be about the TIAA tax deferred annuity, which classified titles have had access to for a number of years now. And afterwards, we will be hearing from the same presenter from TIAA, but on estate planning. And estate planning, I think, is very important, and it's always been part of these seminars because even if you have to hire an estate advisor or a financial advisor to manage your estate and your assets, giving you some background information helps you to approach an attorney with knowledge and with prepared to ask the right questions. And so the estate planning, I think, is a very valuable presentation. So I hope you stay on until the end. Again, this is being recorded, and a link to the recording will be provided to everyone, even if you haven't attended. So if you miss any part of this presentation, you can go back and re-listen to it. With that, I'd like to invite Shannon Johnson from NYSERS. Shannon, you can go ahead and share your screen, and the floor is yours.
Mhm. Thank you, Talon, and good morning, everyone. Good morning. I'm going to go ahead and share my screen. You should be able to see it. Again, good morning, everyone. Thank you so much, Talon, for inviting me to present on the behalf of NYSERS. Thank you all, of course, for joining us today. And as we all know, one of the greatest benefits of working for New York City is the retirement benefits that it offers. So today I'm going to try to keep it brief, but very high level so that you all have a clear understanding of how the benefits work here at NYSERS. So for those of you who are planning retirement, hopefully the information that you do not know as of yet, you are educated and prepared for your future retirement. Now, before I jump into the actual presentation, I do want to tell you a little bit about NYSERS. We are a cost-sharing, multi-employer public retirement system that provides a defined benefit to its members and retirees. We're actually one of the largest municipal public retirement systems in the U.S. with over 400,000 active members and retirees. So here, the members contribute to their pension benefit along with earnings from the fund's investments. And as I get into this presentation, I will discuss more on how those contributions work. So today we are focusing on Tier 4 and Tier 6. So if you joined after July 26, 1976, but by March 31st of 2012, you are a Tier 4 member. If you joined April 1st or any time up until present day, you are a Tier 6 member, and we're going to discuss those in detail. Keep in mind before we get started that your membership date is different from your start date. It is very seldom that someone starts city service and joins NYSERS on the same day. So don't be alarmed when you see that your membership date is different from your start date. Now let's jump into Tier 4 membership. So we're starting with the 62.5 Basic 4 plan. So with this plan, at the age of 62 with at least 5 years of service, you are eligible to retire and receive a monthly benefit for the rest of your life. With this plan, which is the original plan, you were required to make a basic member contribution of 3% of your gross wages for 10 years. So for many of you, you would notice that you were initially contributing 3%. After the 10 years of membership, that contribution rate ceased. Now, under this plan, you do have the opportunity to retire early, which we consider tier equity, but that is with a reduction. So you can retire as early as 55 and have a permanent reduction, which we will touch on in this next slide. Now, again, you're able to retire early, but that does come with a reduction. So as early as 55, you're looking at a 27% reduction, and at the least 61, and that is 6% of a reduction. Just keep in mind when you are retiring early and agreeing to the reduction, it is a permanent reduction. So once you turn 62, that benefit does not jump up to what the maximum would have been. That reduction would last a lifetime. But this option is available in the event you are looking to retire a bit earlier. Now let's discuss the 55-25 plan, which is under Chapter 96. In this plan, you would have had to have been employed in an eligible position on June 28, 1995, in order to elect into this plan. Now, with this plan, we only provided a 90-day window in order for you to opt in, and that was between July and September of 1995. So if you did not sign off on the option to opt into this plan, that plan was no longer on the table for you, and you remained in the 62.5 plan. Now, with this plan, you also have the basic member contributions of 3%, but in addition to the basic member contributions, there were also additional member contributions for 30 years at a percentage of 1.85. Of course, that's put in place because you have the ability to retire early with no reduction. Now, with this plan, you cannot retire earlier than 55. You must have at least 25 years of service and 55 or older. If you have less than 25 years of service, the vesting provisions would fall under the 62 plan. So if you have 10 years and you decide to leave your account frozen, which we consider vesting, you would have to wait until 62. The only way to receive your payout at 55 is to accrue a service credit of 25 years. Now let's jump into the 57.5 plan, which is also under Chapter 96. And this plan was only available to new members beginning June 29th of 1995 up until March 31st of 2012. So this plan also has the basic member contributions of 3% for 10 years. and the additional member contributions of 1.85% for 30 years. In this plan, you are eligible to retire at 57, and there is no earlier retirement. So if you vest with at least 5 years of service and leave your account frozen here, you would receive your benefit at the age of 57, no reduction for the rest of your life. Now let's talk about the additional member contributions a bit, because there are some of you who may be in the 55-25 or 57-5, and you're approaching 62 or 61 and did not get the opportunity to take advantage of early retirement. There are some instances in which you would be eligible for a refund of the employee contribution, which is 50% of the additional member contributions. These examples are the death of the participant, of the member, so that would be refunded to your beneficiaries that you have listed on file. If you have a service retirement at the age of 62 or later, you are eligible for the employee portion of the additional member contributions. So even if you are one day away from 62, you will not receive that refund unless you are 62 years or older. So just keep that in mind when thinking about your additional member contributions. If you have to retire under disability retirement, you are eligible to receive the additional member contributions. And also, if you transfer to another public employee retirement system in New York State, other than the Board of Education retirement system, you are eligible for that refund as well. Now, we also have some of you who may fall under physically taxing. Now, physically taxing is created by and may be amended by the New York City Office of Labor Relations. NYSERS does not determine the positions that fall under physically taxing. But if you are in a physically taxing position, which would only fall under one of the early retirement plans, which is the 55-25 or the 57-5, you must pay the basic member contributions of 3%, the additional member contributions of 1.85% for 30 years, plus the physically taxing additional member contributions of 1.98% for 30 years. So under physically taxing, there are 3 mandatory contribution rates. Now, with physically taxing, you are eligible to retire at the age of 50 with 25 years of physically taxing service, and you would receive no reduction in your benefit. Now, for the physically taxing, of course, there's also instances in which you may be eligible for a refund of those contributions. So you would also be eligible to receive the 50%, the employee portion of that 1.98 rate, if you have 25 years or more credit in physically taxing and is at least 55 years of age. So that would mean you did not get the opportunity to take advantage of the physically taxing early retirement at 50. So if you're at least 55 with 25 years or more, you are entitled to that refund. The same with the 57-5. If you have 25 years or more in credited service in that physically taxing title and at least 57 years of age, you are entitled to that refund. So keep that in mind if you are in a physically taxing position. Now let's talk about Tier 6 membership. So we have the 63.5, which is the basic Tier 6 plan. This became available to all members who joined on April 1st, 2012 and thereafter. Now, unlike the Tier 4 plans, the basic member contributions that you pay, they not only last for 10 years, they are a lifetime. Okay, so for as long as you are actively working up until retirement, you will be paying your basic member contributions. These contributions are based upon your salary. So there's no set 3% rate across the board. It is based on your salary, and we do review on an annual basis to determine whether your percentage should increase or decrease. Now, because we do determine based on your salary, you're unable to increase or decrease those deductions. We would review and we would notify you of any changes before they take effect. Now, in this plan, you are eligible at the age of 63 with at least 5 years of credited service. So if you decide to accrue at least 5 years and separate from city service, your eligibility age will be 63. Now, with this plan, there is also tier equity that allows you to retire early with a reduction, but it does differ from tier 4. With the basic tier 6 plan 63.5, if you retire as early as 55, you would have a 52% reduction in your benefit. If you decide to wait until 62, it is a 6.5% reduction. And for anyone who is just joining, just like tier 4, this reduction is permanent. You are unable to receive an increase. So once you turn 63, your benefit will not jump up to an unreduced amount. It will be reduced for the rest of your life. Now, to discuss the contribution rates a bit, for salaries up to 45,000, it is at 3%, and we only have a maximum of 6%, and that is for salaries greater than 100,000. Now, there was a law that was recently passed in which starting October 1st, these contribution rates will change. The greatest percentage will be 5.75%, and the minimum will remain 3%. Now, before we make any changes, of course, we will be sending out notifications to our members, and we will be posting all updates on nicers.org. So if you want to stay up to date and make sure you are aware of what's happening, you can always go into nicers.org, and every update that happens within nicers or any laws that are passed, they are always available for your reading on nicers.org. So just keep that in mind. October 1st, there is going to be a change implemented in the contribution rates for tier 6.
Shannon, can I interrupt you for a second? There's a question in the chat. Does the Board of Ed retirement system include private schools?
I am not sure about that.
How about
They
charter schools?
That I'm not sure
Okay,
because since I'm not the Board of Ed, I would definitely encourage whomever asks that question to reach out to the Board of Ed to see
yeah,
which agencies would
yeah, that's a
fall under.
PSC question. Okay,
Yeah, they'll
thanks.
definitely be able to answer that. But thank you for
Okay.
that. Okay, so now we're going to move into service credit. Now, there are different types of service credit, of course, that would count towards your retirement. And the more service credit you have, the higher your pension benefit will be in the future. So if your membership service, meaning any service that you've accrued while being a member of NICERS, purchase service, which I'll discuss more in some upcoming slides, but this is for any public pension service that you've rendered within New York State that you've purchased to have added to your service summary. Military service, which I'll touch on as well. Membership reinstatements, transferred service, union leave, and part-time service. So for some individuals, they feel like part-time does not count. Every minute that you work counts. So whether you are part-time or full-time, your service does count towards your future retirement benefit. Now, for membership service, full-time service is considered 1,827 hours per year, which is 70 hours in a biweekly pay period, and 35 hours in a weekly period. So if you were to work, let's say 80 hours in a biweekly pay period, just keep in mind we cannot credit more than a week in 1 week. So if you work beyond the 1,827 hours in a year, you will still see 1 year of credited service. So that's a common question that we get. So I just want to make that clear. Now, anything less than 1,827 hours is considered partial service. It doesn't mean you've only worked 6 months. It simply means that you've worked something less than a year. So even if it was, for example, 11 months and 28 days, you may see that it's labeled partial service, but you've received credit for the full 11 months and 28 days. So just keep that in mind when reviewing your summary. If you see anything less than a year, that would mean that 1,827 hours for that year was not reached based on the report we received from your agency. Now, to talk about buyback just a little, when in doubt, apply. If you believe there is some service that could be eligible for a buyback and you are looking to get more credit towards your service summary, apply for that buyback. Okay. Now, when we are looking at the cost, it is 3% of the basic member contributions for Tier 4, 6% for Tier 6 members. If you are in an early retirement plan, the 5525 or the 57.5, you will have to also pay the additional member contributions, plus the 5% interest compounded annually. Okay. If you are thinking about applying for a buyback, be sure to apply for it before you retire. So we must receive that application at least 1 day before your actual retirement date. And again, buyback is completely optional. It is not mandatory, but the more credit you have, the better your pension benefit will be in the future. Now, with military buyback, you are allowed to purchase military service as well. You must be prepared to provide your DD 214 when applying for the military buyback. For the cost of a military buyback, it's either 3% or 6%, depending on if you're a Tier 4 or a Tier 6, and that would be times by the number of years of military service being purchased and the salary you earned during the 12 months prior to the date of your application. But you are eligible to purchase military service as well, which counts towards a greater pension benefit. Now, applying for buyback. Once we've received your application, whether you log into your My NYSERS account and do it online, which is the quickest, easiest way to go about it, or whether you decide to download and mail or drop off Form 241, after we receive those applications, we verify your service and salary information for the period claimed. So when we're factoring the cost, keep in mind, we're not charging you based on what you currently make. Because of course, for many of us, as we've continued to work, we've continued to grow in salary. So we will not make the cost around your current salary. That cost would reflect what you earned during the periods that you are applying for. Once we have verified that information, we would send you a cost letter. That cost letter would include, of course, the cost and all of your payment options, which are listed in this slide on the screen. Please keep in mind, if you are a new member, if we have any new members that are attending, we do not credit your purchase service until you have 2 years of membership. So if you've fully completed your buyback, it's purchased, and you have 1 year of service and you do not see your buyback service, don't be alarmed. That service will be updated, but we would have to wait until you've completed 2 years of membership. But the sooner you start your buyback, if you're thinking about it, the better, and the less the cost because of the interest that it does accrue the longer you wait. Now, leave without pay. This is service rendered during employment that was unpaid and that does not count towards your credited service. That includes FMLA, medical leave, parental leave, and suspension. These are periods you do not receive credit for, and these are periods that you are unable to buy back service for. So keep that in mind when you are taking your leaves or reviewing your service summary for missing service. Now, transfers and reinstatements. This is service that would count towards your pension as well. Now, if you were a part of any of these systems listed and you decided to join with NYCERS, you are able to contact the retirement systems with your membership information. They would then transfer everything over to NYCERS, and you would then see everything that you should have credited under your NYCERS retirement. And that can be done vice versa. If you leave an agency that's covered under NYCERS and you join with another under one of these systems, you are able to reach out to us here at NYCERS with your membership information, and we would then transfer everything over to that new system so you would have credit. In addition to that, reinstatements. If in fact you were a member of one of these systems and decided to take a refund of contributions and you decide to rejoin, let's say with us here at NYCERS, you are able to put in for a tier reinstatement so we can reinstate that previous membership you had, including your tier, your contributions, which you would put back in, and your service, and that counts towards your future retirement benefit, so you don't lose. Now, what if you leave city service before eligibility for retirement? There are several ways that this can go, and there is no instance in which you would lose what you've contributed. Whether you decide to vest, meaning you've accrued at least 5 years of credited service, and decide, hey, I want to leave it here vested until I reach my required age of my plan and collect for the rest of my life. You also have the option for a refund. If you have less than 10 years of credited service, you can request a full refund, including all of the interest that it has accrued. Now, if you do withdraw your contributions, we do terminate your membership and you do forfeit the right to a future benefit from NYCERS. So if you take that refund and start to work for the city again, you would have to rejoin as a new member. And transfers, as discussed in the previous slide. If you become a member of one of the other 7 public pension systems in New York State, you can move your contributions and your service credit to that new system. So again, there's no instance in which you would lose out on your contributions. Now, there are other NYCERS benefits that you can, of course, take advantage of while you are actively working, starting with loans. As a member, after 1 year of membership, you are eligible to borrow up to 75% of your account balance, equaling $1,000 or more. Now, we do allow one loan every 12 months, and we do not permit any emergency loans. So if you received a loan this year on March 4th of 2026, your eligibility date will be March 4th, 2027. Again, you must have at least 1 year of membership service before being eligible, and you must be on active payroll when you apply for the loan. We do deduct these loans through payroll deductions, and we allow you within 5 years to pay back this loan. If you would like to pay it sooner, of course, you have the ability to choose a lesser repayment schedule. You also have the ability to make lump sum payments towards it by logging into your My NYCERS account, and you are not penalized for any early payments. Now, we do have a 6.2 interest rate, including insurance. That is a fixed rate for everyone. And there is a $40 processing fee per transaction, which we would withdraw from your requested loan amount. Now, with this loan, it does not affect your credit rating. We do not report our loans to any credit bureaus, so it does not affect your score. And although you are borrowing against your account balance, it is derived from a different fund, so you will continue to accrue that 5% interest on your full account balance. Now, keep in mind, this loan works like any other loan that you may take, a home loan, a car loan, a bank loan. You are paying NYSERS back along with the 6.2% interest. Any outstanding loans at retirement permanently reduces your balance, your retirement allowance. So keep in mind this balance does not affect, of course, you retiring. If you have an account, a loan account balance, you can still retire, but it will reduce you based on what the balance is and based on your age. And because this is a permanent reduction, it does not feed into that balance. So that balance is not decreasing over time. That permanent reduction lasts a lifetime. And you do have the opportunity to pay it off in a lump sum or even partially pay it before you retire to decrease your reduction amount if necessary. Now, we also have disability retirement. Of course, injuries or illnesses can happen at any time unplanned, and we have disability retirement available for those cases. We have an ordinary disability retirement benefit, and that is if you have 10 years or more of credited service and no longer able to perform the duties of your title, regardless of your age. We also have the accidental disability retirement benefit, and these are for members with less than 10 years of credited service. If an accident happens from the first date of membership while in performance of your duties on the job through no fault of your own. So these options are available, but keep in mind, we do have a NYSERS medical board here that makes the recommendations on those applications. So you would have to be prepared to provide supporting documents to support the claim for that illness or that injury, but this option is available. We also have an ordinary death benefit in which, if something were to happen to you while in active service, your beneficiaries would receive this one-time lump sum. So we have the benefits, of course, starting at if you have 1 year but less than 2 years, that's 1 year of your salary, up to if you have 3 years and beyond, that's 3 years of your salary. Not only would they receive up to 3 years of your salary, they would also receive a full refund of your contribution, your basic member contributions, and the interest accrued. And if you are in an early retirement plan, they would receive the employee share as well of the additional member contributions along with the accrued interest. So keep those beneficiary designations up to date. Any updates that you make with your employer or with your union, NYSERS does not receive notification because this is a separate benefit. So always keep your designations up to date, and I would strongly suggest utilizing My NYSERS to keep your account up to date. Now let's touch on the retirement process for those of you who are close to retirement or thinking about retirement or wanting to start your planning. So we will need your last date on payroll. So that means you are communicating with your agency first. You want to confirm what your last date on payroll would be so it does not cross into your retirement date. Once you have established and confirmed your last date on payroll, you can file your retirement application. At the earliest, we accept that application 90 days prior to your retirement date, and we would like to receive it at the very least 30 days before your retirement date. If you submit it later, that's fine, but of course, the sooner the better so that we can start to work on and process your account. Now, when you start your retirement process, we do provide to you temporary options. This is in the event you were to pass away prior to receiving your full benefit, we would like to pass that on to a beneficiary so they could receive the benefit for the rest of their life. You also have the ability to file for direct deposit. We do have a Form 380 that is either available on mynicers.org, or if you decide to file in person, you can file that form as well if you would prefer electronic transfer over mailing. And as far as notification to Office of Labor Relations for your health benefit, NYSERS will notify OLR of your retirement filing so that they can proceed accordingly for your health benefits. Now, the advance payments, which are considered partial payments, these payments you initially receive while we calculate and process what your finalized benefit would look like. If you retire on the 1st or 2nd of the month, you will receive your first advance payment at the end of the same month in which you retired. If you retire on the 3rd of the month or any time after, you will receive your first advance payment at the end of the following month. So that's important, of course, to remember for when you're planning for your expenses and your monthly bills or anything of that nature, that on the 3rd or after, you will be waiting until the end of the following month to receive your first advance payment. Now let's discuss final average salary, okay, which in conjunction with your service credit, your final average salary is what would determine what your final monthly benefit would be for the rest of your life. So your final average salary is either the wages earned in any 3 consecutive calendar years, or the average wages earned in the 36 months immediately preceding your retirement date, whichever is greater. Now, for Tier 4 members, we will do a 5-year look back to see where your money was earned, not paid. So if there was a, let's say, contract settlement or a union settlement, we would take a 5-year look back to see where we would need to reallocate the funds to make sure we are appropriately reviewing what your final average salary would be, and there doesn't appear to be a huge jump from one year to the next year. For Tier 6 members, we will do a 7-year look back to determine where those funds were actually earned, not paid. So keep that in mind. So when we are looking at final average salary, we will determine here at NYSERS what the greater of the benefit would be for you, whether it's the 3 consecutive years or whether it's the 36 months immediately preceding your retirement date. Now let's discuss the formula a bit. Now, although I am unable to answer any account-specific questions in this seminar or provide actual calculations, here are the formulas so that you can either, play around with the numbers yourself, or you can log into your MyNYSERS account and there is a retirement benefit calculator available there for you as well. Now, when calculating for Tier 4 and Tier 6, if you have less than 20 years of service, that is 1.67% multiplied by your years of credited service, multiplied by your final average salary. Now, for Tier 4 members, if you're 20 to 30 years, that's 2% multiplied by your years of service by your final average salary. If you have 30 years, that's 60% of your final average salary. And if you have more than 30 years, that is 1.5% times the years of credited service in excess of 30 multiplied by your final average salary. Now, for Tier 6 members, if you have 20 years, that is 35% of your final average salary, and anything more than 20 years, that is 2% by each year of credited service in excess of 20 by your final average salary. And again, you can utilize your My Nicers. There is a benefit calculator available, so it doesn't matter how young you may be. You can log in and utilize that calculator just to get an idea of what your future benefit may be, or just to put in future salaries to see if you continue to increase your years and your salary, what it may look like for you in the future. Utilize that. Now let's talk about final retirement options. So this, of course, is after you've been receiving your partial payments, which are advance payments, for a few months. We do send you a finalized option packet with several options, including the option for maximum. So if you decide, I do not want a beneficiary to pass on my benefit to for the rest of their life, I don't want a reduction, I want my maximum allowance. When you receive your finalized option, you have the ability to make that change. You also have the ability to designate 25% to 100% to a survivor, and that would pass on to that survivor for the rest of their life. Now, with 5 years certain and 10 years certain, with these two options, there is an expiration for that beneficiary. For you as a pensioner, you would receive your benefit for your lifetime. But in the event you choose one of these options and you live past the 5 years or past the 10 years, there is no benefit remaining to pass on to that beneficiary. So I want to make it clear with that option. If you live beyond 5 or 10 years, it lasts a lifetime for you, but there is no longer a benefit for your beneficiary that you designated. Then there is also option 5, which is the 50% or 100% pop-up. With this option, if your beneficiary predeceased you, your benefit would then jump up, so pop up to the maximum retirement allowance you would have received had you not designated a beneficiary to begin with. Now, for option 1 through 5, there is a reduction with these because, of course, it passes on to your beneficiary for the rest of their life. There is no set calculation across the board. These reductions would be determined by your beneficiary's age. So the younger your beneficiary, the more the reduction would look like for you. Now, with finalization, after you have,
Shannon, can I
yeah.
interrupt you for a second? Because
Mhm.
there was a section at the bottom of the prior screen that I think is worth noting about the fact that a beneficiary is permanent. And I don't know if, I just want people to understand that once if you name if you name your spouse a beneficiary on your pension, and at some point you get divorced, that person remains the beneficiary. There's no it's irrevocable, it's permanent. So, even if you get a divorce, that person stays on your pension. So keep that in mind when you make your decision about which of these options you want to utilize.
Yes, and I was going to touch on that on this
Okay,
slide.
sorry.
No, 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 you're fine. You're fine. Because that actually needs to be reiterated because that's a common question and concern. So I do appreciate you for jumping in for that because you can't hear that enough. So, of course, when you are being finalized, after you've selected your option, which is final. So with what you selected, if you decide in the future, okay, I no longer want that option. I want my full benefit. You're not able to make a change. Or if you decide I no longer want this beneficiary, I actually would like to designate another instead. Those options are final. So you're not able to change your option nor your beneficiary. So keep that in mind when you are reviewing your option package. Now, we do give you 60 days when you receive your option package to fully review those numbers, to fully think about who you would like to designate, if anyone. So utilize that time when you receive your final option package to make a good decision based upon what you need for your future, of course, and what your beneficiary may need. Now, anytime you are finalized, of course, if there is a difference between your advance payment and your finalized payment, which always happens for the most part, you are due retroactive monies. So you would notice for your very first finalized check, it would be larger than your future checks because we would be paying you back everything you're owed dating back to your retirement date. Now, again, we do give the 60 days for you to review, but make sure within that 60 days, you are prepared to submit your option selection in a timely fashion because you can either have your advance payment suspended until you submit your selection or possibly be finalized under your temporary option. So you don't want to be forced into a decision that you did not get to make on your own. So just keep that in mind when you're reviewing your finalized packet, whether it's your beneficiaries, your actual option for the benefit you would get for lifetime, as well as the consequence to not submitting it in a timely fashion. Now let's touch on taxation a little bit. Now, for your pension benefit, you are subject to federal income taxes, but you are exempt from New York state and local taxes if you reside within the state of New York or New York City, of course, after you retire. Now, you can reside anywhere you'd like after retiring, but in the event you reside within a state that requires state and local taxes, you would have to handle it with the Internal Revenue Service within that state because we will not withhold it here in New York State. Now, after you retire, you will be receiving a 1099-R each January. This is what you would utilize to file your taxes to report the income from the previous tax year. Now, we do not have any tax preparers or tax experts here at NYCERS, so we are unable to tell you exactly what amount of federal taxes you should have withheld. I do strongly suggest speaking with your accountant or your tax preparer if you would like to know what to have withheld. And keep in mind, you can make changes as much as you'd like, and you can log into your My NYCERS and utilize the changes for federal tax withholding easily if you need to. Now, working after retirement. I know some of you may say, I have not retired yet. Why would I be thinking about returning back to work? But there are instances in which people return back to work, whether it's, by choice or by need. And we want you to know what your options are and what the earnings limitations would be in the event you decided to do so. Now, if you are a service retiree, and you are over 65, so 65 or older, there is no earning limitation for you. There's also no earnings limitations if you are under 65 and either work for a private sector, a public agency in another state outside of New York, the federal government, if you work for a public school in New York City or New York State, or if you return to a public benefit corporation such as New York City Health and Hospitals or New York City Transit Authority. Now, if you're under the age of 65 and you decide you want to work for New York City or New York State, you are subject to an annual limit of $35,000. So if we see that you've earned more than $35,000, if we see that you've earned more than $35,000, we would suspend your benefit for the remainder of the calendar year, and we would review after that calendar year to see if you have still exceeded that earnings limitation. If you have not, then we can resume your pension benefit, and if you have, we would continue to suspend your benefit. So keep that in mind. But again, if you go to that public corporation, HHC, New York City Transit, a public school in New York State or New York City, there's no earnings limitations. Those are need-based agencies. So keep that in mind. Now, here are some resources that you can utilize as a member. Okay, we do have Terry, which is our enhanced virtual agent, and that is a public facing virtual agent in which if you would like to go to nicers.org but not log into your My Nicers and you would like to know, where can I find the buyback form? What is Nicers address? What is the mailing address? You're able to utilize the virtual agent to direct you to different things that you may need on the site that you may not be able to easily find. If you are logged in to your My Nicers account, we do now have Atlas, which I will have to add to this presentation. This is our newly introduced virtual agent that is available and that can provide account specific information when you're logged into your My Nicers account. So if you have a loan application being processed and you want to say, hey, Atlas, when is my loan going to be processed? That virtual agent can provide that information to you. Not only can they provide that information, but if you are asking account specific questions that the agent cannot access, they can transfer you to a live agent between the hours of 9 a.m. to 11 a.m. Tuesday through Thursday, and you would be speaking with a live Nicers representative. Now, we are working to expand that availability. So anytime you're logged into My Nicers, just check out our virtual agent, and that can give you lots of information without you having to call or visit the walk-in center. Again, I know I've said My Nicers probably 10 plus times because I am a strong advocate of My Nicers. It is the easiest, most quickest way to keep track of your account. I use it almost daily, and I am not near retirement right now, but I utilize it to update my beneficiaries. So I encourage you all to do so as well. You're also able to update your address, apply for loans, play with the benefit calculator and look at what your future retirement would be, and more. So do register for My Nicers if you are not already. And if you are registered and you don't utilize it, log in, take a look at it. You'll be surprised at all of the features that we have available, and that would save you the time of calling or having to walk in person. Now, here are some resources you can utilize if you're unable to get questions answered on this presentation, if they're account specific and we can't go into it, or if you are too shy to ask a question. Please either log into your My Nicers portal. There, you're able to not only utilize Atlas, of course, but we also have the submit web inquiry option where you can create your own case, detail it. We have an amazing quality assurance team, which I was once a part of as well, that reviews the cases, and they pass it to the necessary business unit and get you all of the answers you need. You also can visit our walk-in center or contact our call center Monday through Friday, 8 a.m. to 5 p.m., excluding any holidays, including our upcoming holiday on Friday. And here's our mailing address as well. Just keep in mind, this is strictly a mailing address. If you try to visit Long Island City, there is no way to visit. Our only walk-in center is downtown Brooklyn at 340 J Street. Now, here are some resources if you would like to read more on earnings limitations for service and disability retirees. If you would like to look at loan reduction factors, these can change on an annual basis. So right now, there's an update for 2026. If you're retiring in 2028, it may be different. So you can review those on an annual basis. If you're thinking of possibly returning to public service after retirement, there's a brochure for that, as well as reading more on retirement options, which again, once you're finalized, it is permanent and your beneficiary is permanent as well. But utilize these resources and read on anything that you may need some more information on. Now that does conclude my presentation. Tal and I am available to stick around to ask questions, whether now or I can log back in later to answer during the general Q&A. But I really hope this information was helpful to you all.
Thank you so much, Shannon. That was great. Um,
Thank you.
we have 1 minute, and so I was going to ask, and I know Frank logged in also. So between both of you, if you could, I'll take one oral question if somebody wants to unmute themselves and ask a question, but then I want to move on, but I'm going to ask you and Frank if you could possibly respond to the questions in the Q&A. And there's one question in the chat function. I've made both of you co-hosts, so if you're able to do that, I would really appreciate it. That way we can stay on schedule. But does anybody have a question that they wanted to ask directly?
Yes, quickly.
Okay.
Good
Hi,
morning,
Charmaine.
Shannon. Hi, Talon. I tried scheduling an appointment yesterday with NICERS online, and it's not allowing me to do it. I've tried this before several months ago, and I can't make the appointment online. So is it because I'm not using the AI, or just when you sign into your account that's what's going on? I think it's blocked because I received the same thing a few months ago.
Mhm. So what I can tell you is it's not because of the AI, the virtual agent. That's just an option to, just get some answers to questions that you may have. The appointments fly. Okay, so every time you logged in at that point, that just means that there was no appointment available. But keep in mind, we do accept walk-ins. What I
Okay.
would suggest, if you are walking in and would like to sit down with a counselor or talk to
Yes.
an expert at the counter, keep your day free. Don't assume that it might just be an hour. There may be a little bit of a wait, but we do accept walk-ins. So you
Okay.
can just come into our downtown Brooklyn office at 340 J Street and walk in, or you can submit a web inquiry on My NICERS under the I need help, contact NICERS option,
Okay.
and you can
Okay.
indicate I'm looking to possibly retire. Include that information, include your tentative retirement date, or if you actually have a last date on payroll, even better, include that information and state, I would like to sit down with a counselor, but I'm unable to access any appointments, so that we can try to forward it and see what openings we have as well. That's an option that you can utilize.
Thank you so much. We'll do that. I had
Absolutely.
no intentions of thinking it would just be a few minutes. I would take a day off to do this. Thank you so
Yes,
much.
take a day off. Treat it as like a mental day or an
A
Yes.
errand
field
day.
trip.
Yes. And Talon,
Yes.
apparently the form that I was sent from NICERS, I have to print it and fill it out. It's not a writable PDF.
Okay.
Um, So that's taking some time, but I'm
Okay.
glad I'm getting somewhere, Shannon. I'm glad I'm getting somewhere. Thank you.
Okay, good.
Okay,
Good.
that's it. Thank you.
Absolutely.
Bye-bye.
All right. Thank you so much, Shannon. I appreciate your time and expertise. And there's some questions. If between you and Frank you could answer them, that'd be really great so that I can move on. Thanks again.
Absolutely. Thank you for having us.
Of course. Our next presenter is Peter Quinn from the 457 plan with Nationwide. Peter, are you there?
I'm here. Can you hear me?
Yes, I could hear you. You've been made a co-host, so you can go ahead and share your
Excellent.
presentation and proceed.
Great. Let me just. And then if you could just let me know when you
Yep,
see the
I
screen.
could see it. We could see it.
Okay. Well, good morning, everyone. Appreciate you joining us. Again, my name's Peter Quinn. I'm one of the account reps for the New York State Deferred Compensation Plan. We actually have reps all around the state. So depending upon where you live and where you work, there's a rep in your territory. I cover Manhattan and Staten Island. We have a rep for Brooklyn and Queens, Shirley Genty, and Lizette Ramos covers the Bronx. But today I'm here to actually talk about getting ready for retirement. And, this applies not just to someone who has 5 or 10 years to go to retirement. I think it also applies for someone just starting out, just things you need to think about when you're planning for retirement. We tried to keep it simple. We broke it down into 4 easy steps. One, determining what your income need is. What expenses do you have maybe on a monthly basis? What income will you have coming in? If there's a gap, let's talk about ways that we can close that gap. We'll discuss some of the risks in retirement, like inflation risk, things like that. And then, most importantly, keep the plan simple. So one way to help in retirement is the plan that New York State offers, which is the New York State Deferred Compensation Plan. It's also known as a 457B plan. 457 is just an IRS code section like 401k or 403B. But what it allows you to do, and it's a real simple program because contributing can be done all through payroll. So you can elect to have each paycheck, a certain amount, come out of your paycheck and go into the 457 or the deferred comp plan. You can get in as little as 1%. It's a couple of Starbucks a week. And anything decision, election that you make in this plan can be changed at any time. You could change your contribution, raise it or lower it, change your investment option. And like a 401k and a 403b, with this plan, you can elect to do either a pre-tax contribution or an after-tax Roth. And I'll just do this real quick and keep it simple with round numbers. If you're making $100,000 a year and you put away 10% of your salary over the year, so that's $10,000, and you do it on a pre-tax basis, you get a deduction for that $10,000. So you're paying tax on 90, not 100. The money grows tax deferred, and what I mean by that is any growth from your investment you're not paying tax on. But then when you hit retirement, because that money's never been taxed, as you pull the money out, each time you pull money out, there's a tax withholding, typically 20%. The Roth works differently. If you contributed to the Roth with $100,000 and you do it on an after-tax basis, that $10,000 you're not getting a deduction for, so you're still paying tax on the full $100,000, even though you're contributing $10,000 to the plan. But the money grows tax deferred, so whatever growth you have on your contributions, you're not paying tax on. And then on the back end, when you pull the money out, it's tax-free. So a lot of people have a lot of pre-tax retirement savings. A lot of people will be getting a pension from the state that's taxable. When they start getting Social Security, that's taxable. It's kind of a good idea to think about, well, maybe I'll start putting money away in this account, this Roth account, that won't be taxable when I pull money out. Almost the same way that you would diversify your investments. You're diversifying your retirement income. You're going to have pre-tax or taxable income coming from pension and Social Security, and then you'll have some non-taxable amount if you're doing the Roth. So a lot of industry experts say you need about 70 to 80% of your final pay to live comfortably in retirement. I may disagree with this for Peter Quinn because, I look at what I spend on the weekends versus what I spend during the week. And I typically spend more on the weekends. So you may even need more than that 70 to 80%.
I don't know how long it's going to be.
Hello? Okay. So here's where you have different amounts of retirement income coming in. If you estimate your pension, if you're working for the state 20, 30 years, maybe your pension's going to be 50% of your final income. Maybe you'll be getting $3,000 or $4,000 a month when you start taking Social Security. Maybe that's another 25%. What can make up that gap that you're going to have? And the deferred comp can be part of that. If you start contributing, a small percentage each pay period, adds up quickly, and that could help close that gap on your retirement income. So again, keeping it simple, how much are you going to have? How much are you going to need in retirement? What are your expenses? What are you going to need each month? What will be coming in with your pension, Social Security? And then how can you possibly close that gap? So things to think about on how you can close that gap. You know, every time, and I tell this even to people just enrolling brand new, you know, if you're starting low, maybe contributing 1, 2, 3%, every time you get a raise, every time you get your annual review and you're getting a 3 or a 4% increase, take 1% of that 3% increase and increase your contribution to the plan. You're still going to be taking home more money, but when you start raising your contribution each pay period, that's when your accumulations, that's when your account really starts to snowball. Another possibility is when the kids leave home. You know, I'm an empty nester now. We don't have a lot of that support now to the kids as we did before. Turn those extra dollars into contributions. And also, anytime you reduce debt, you have a car loan, your mortgage is paid off, anything that's a regular payment that you don't need to make anymore, consider making that an extra contribution into the plan. So we have a great tool on our website. It's called My Income Retirement Planner, or MERP, and it allows you to input all this information specifically for you. You could put in, what am I paying for rent or mortgage? What's my monthly living expenses? How often I go out to eat? All those different estimates. And then it also allows you to put in what your estimated pension is. And it does some estimations for you automatically. You know, it's not as accurate as if going to get your actual amount, but it can, you know, based on, you know, how many years of service, what your Social Security is, it'll give you estimates and kind of give you an idea of, you know, what's the likelihood of you retiring comfortably. And if you see that it's low, maybe there's some adjustments that you need to start making, maybe making other contributions to a savings program. So you already talked about the pension earlier. Here's how to get in touch with them. I suggest everybody, even if you're not close to retirement, set up an account with Social Security. Go to ssa.gov. It'll allow you to set up an account. It'll show how much you've contributed to Social Security over your lifetime. It'll show you what your estimated pension is. For most people, their Social Security retirement age is going to be age 67. That's when you'll get 100% of your retirement benefit. If you take it early, as early as age 62, there's a reduction in that. It's not going to be 100%, probably be more like 70%. The other option is deferring or delaying taking Social Security after 67, maybe going to age 70, and there you'll get about 120%. And once you make that election, that's kind of stuck for life. You can't go back and switch it. So a good idea to go on, create an account, see what your numbers look like to help you decide when can you take the money. The longer you could wait, the better it is for you. So here are the limits for the 457 plan. Very similar to the 401k limit, 403b. The regular limit for most people is $24,500. Excuse me one second. I have to. $24,500. If you're above age 50, you could do the 24,500 plus an additional 7,500, bringing you to 32,500. I think the government rationale is, you know, a lot of times people start out not making a lot of money, contributing small amounts at the start. Maybe they get older and they realize, you know, hey, I haven't done enough retirement savings, and they allow you to do that catch up after age 50. Something that was added last year was if you're between 60 and 63, That catch up is 11,250. So it's the 24.5 plus the 11,250. One rule change for 2026, and everybody should kind of keep a mental note of that. If you made more than 150,000 last year, if you made more than 150,000 in 2025, your catch-up contribution, whether it's the 7,500 or the 11,250, has to go into a Roth. That just happened this year. It's a brand new change. If you need to talk about it in more detail, I'm happy to do that. But just be aware, they call them high income earners, if you made more than 150 last year in 2025, your catch up needs to go into a Roth contribution. I mean, not a bad thing, but maybe not exactly what somebody had planned. So again, talk to a professional, talk to me. Happy to help with that and kind of go through it with you. So some of the risks that you need to think about when you're planning for retirement. One is life expectancy. You don't want to, if you're planning to live in retirement for 20 years and you have, a long life expectancy, I mean, you could be in retirement for 30 years. Those are things you need to think about. You need to plan against inflation. What's the cost of goods and services going up every year? Healthcare costs are becoming a bigger and bigger part of part of someone's expenses in retirement. And also, and this happened to me personally, just the need to take care of an adult parent or a child. So those are things all that can have change your retirement expenses. So as far as life expectancy goes, men tend to live to age 84, women to age 87. I go back and I look at, my mom was 97 when she passed away a few years ago. My dad was 95. Hopefully I got those genes and I have that, longevity. But those are things that you have to think about when you are planning for retirement. You need to think about inflation. And these numbers have just, changed this last year. Everybody's aware of it. The cost of, a stamp, the cost of gasoline. Luckily, gas has come down the last week or so, but, on average, it's anywhere between $4 and $4.25, depending upon where you live. You look at movie tickets, right? $11.31. By the time you go to a ball game or something like that, with everything you're paying for concessions, it's expensive. So those are things to think about. Kind of an exception on here, I guess, would be Nick tickets. Those are a little outrageous. So another thing you need to think about when you're thinking about inflation, typically your pension and your Social Security, even though a lot of them have inflation factors in it, I know your Social Security does, that went up about 3%. It's not typically going up at the same percentage your expenses are. So you could start out right now and you're like, okay, my income coming in is greater than my current expenses. So I'm in the plus. But if inflation is growing at a higher percentage than your retirement income, you could be in the negative 10, 20 years from now. Again, something to think about, something to prepare to put away a little bit more money so you have a bigger cushion there. So a question that we get at deferred comp is, when can I start pulling money out of the deferred comp plan? And you could do that as soon as you separate from service from your employer. So, if you decide to leave even at age 55 or 50, and you have an accumulation in the deferred comp, you could start pulling money out of the plan without penalty at any age, as soon as you separate from service. Something you do need to be aware of The government doesn't allow you to keep the money in the plan forever. They do require you to start taking RMDs, required minimum distributions. Real small amounts, maybe it's 3 or 4% of your balance, but you have to start doing that at age 73 unless you're still working. So another question that we get with deferred comp is, well, how can I start pulling my money out? What are my options? You could always take the full balance out at any time. You want to take a full lump sum. A lot of people just take money out when they need it, partial distributions, and again, pay tax on the pre-tax version. Most people take some sort of systematic payments. Maybe their pension is $4,000 a month. Maybe their expenses are $5,000 a month. They call us and say, hey, deferred comp, I'd like you to deposit $1,000 a month into my checking every month to cover my expenses. And you can do this for a fixed term, a fixed dollar amount. A lot of people will do the systematic payments until they start taking Social Security. Now they're getting another $3,000 or $4,000 a month from Social Security, and they shut off getting the $1,000 contribution into their checking because they don't need it at that time. With regard to the Roth, you have to keep the money in there for the later of 5 years or age 59 and a half. Again, the distributions, once you start taking them out after 59 and a half, those are income tax free, and also income tax free to your beneficiary as well. I talked about for the pre-tax distributions, there's a mandatory 20% withholding. So if you're calling us and you're saying, well, you know what, send me $10,000. I need money from my deferred comp. We'll take 20% of that. 20% of the 10,000 is $2,000. That gets sent to the government, and we'll send you an $8,000 check. If you're taking periodic payments on a regular basis, your withholdings can be reduced down to 10%. Here's an important fact that you need to think about. If you're a New York State resident, so you reside in New York State as your permanent address, the first $20,000 from the deferred comp plan is not subject to state income tax. Still subject to federal, but I try to tell people, well, if you can keep your distributions down to $20,000, there's no state tax on that money. So again, nice advantage there. If you need to pull out more, it's only the amount that's above the 20 that's going to be subject to state taxes. Another big question, I'm retiring. I don't need the money right away, or I don't need the full amount. Can I keep the money with deferred comp? And the answer is yes. A lot of people they've done well on their investments with us. Our expenses are very low. This is one of the largest retirement plans in the country. We have over 300,000 participants from, Buffalo, Albany, New York City to Montauk Point. We have $50 billion in the plan. So when we go to the investment houses, the mutual fund companies, like Fidelity, like Vanguard, we get the lowest possible fees. So a lot of people like to keep the money with us. It gives convenient access to the money. And, our website is great with that My Income Retirement Planning, all the seminars that we do on a regular basis. You're getting unbiased educational services. You can also transfer other dollars into the program. So if you were part of a 401k or a 403b, you want to put all your retirement assets in one place, we do allow for rollovers from other plans into our program. So just a couple of things, again, to keep this simple. Review your beneficiary designations. Maybe when you enrolled into the plan, you weren't married, and now you're married, maybe you have kids. Make sure your beneficiary designations are up to date. Review your asset allocation. I mean, one thing that I see, so I do one-on-one consultations, happy to do that with anyone. who wants to talk about the deferred comp plan. I see a lot of people investing in, multiple large cap investments, and there you're going to get overlap. What one fund is investing in is probably very similar to what another fund is investing. I can't give investment advice, but I can go over and review and talk about the different fund choices. And as I said earlier, that tool that we have on our website, My Income Retirement Planner, is an excellent way to see if you're on track to have a comfortable retirement. We have a great app. You can go to the App Store. It's My Retirement. If you type in My Retirement in the search bar, you'll see My Retirement Nationwide. If you look at the bottom of this slide, that slanted M is the app. Anything you could do on the website, you can do on the app. It's very intuitive, real easy to use. You can change your contribution, change your deferral percentage, change your investments. Anything, again, that you can do on the website is available on the app. You can go and look at your account daily. I recommend people not to do that, but I'm the culprit as well. I look at my retirement account almost on a daily basis as the market's going up and down, especially lately, the big swings that we've had. So here's where you can get more information. We have an 800 number. 800-422-8463 is our helpline. Our website is nysdcp.com, New York State Deferred Compensation Plan.com. We hold regular seminars on Social Security, on the pension plan, on what's happening in the market. Real useful, again, unbiased educational services on the website. Roth calculators, a lot of different tools that are on the website. Here's my information. Feel free to reach out to me. That's my email address, quinp8@nationwide.com. My direct line. We have AE Connect. I was talking about the reps that we have out in the field based on the territory. We also have reps that are available on the phone throughout the day, so that if you can't get in touch with Peter Quinn, call AE Connect and they can help you. The helpline's there to help you with if you need a distribution, if you need to change an investment, if you need to take a loan on your account. We have people available to do that. And then lastly, I will give you my cell phone number. If somebody can throw that in the chat, that would be great. Feel free to just contact me on my cell. That's the easiest place to get me. My cell is 917-861-7235. Peter Quinn, 917-861-7235. And Helen, with that, I will turn it back to you. If there's any questions, if you want to open up turn off the mute button, I'll happy to have about 1 or 2 minutes to take a question if someone has one.
Thank you, Peter. Does anyone have any questions? You can unmute yourself and ask if you'd like.
Kaylin, I do have a question.
Hi, Crystal. Go ahead.
Hi, everybody.
We can barely hear you, though.
Oh, can you hear me better now?
Yes, yes.
Sorry about that. Peter, you said that if we take monthly distributions, then the penalty goes from 20% to 10%?
Right. So a lot of people who, and it's not a penalty, Crystal. It's if it's pre-tax dollars and you've never paid tax on that money, instead of having a 20% withholding, instead of us taking 20% out and send it to the government, we could do as little as 10%. It's really all going to depend on when you do the taxes that year, what's your overall tax rate. So give you an example. Let's say you did 20% withholding and you wound up being more like a 23% tax. You'll have probably a little bit more to pay. A lot of people are in a lower tax bracket when they retire. So we allow you to actually reduce it down to 10% so that you're not paying the tax up front and getting a refund. It's just giving you a little bit more flexibility if you decide to take periodic distributions. Does that help, Crystal?
Yeah, it helps a lot, especially if the person remains on a fixed income. So
Correct.
what about the Roth now? Is there any strategy for the Roth, or is that okay because you've paid up front?
Yeah, good question. Because you paid the tax up front, and the contribution has already been taxed, any growth on the money, any distributions after you hit that 5-year 59.5 rule. So let's say you're in retirement now, you're in your 60s, any money you pull out is tax free. And I like the Roth for a lot of people who've been doing pre-tax almost their whole career. Now they're getting close to retirement. Why not sock a little bit of money away in the Roth account that if you need to take that trip or do whatever you want, you don't want to have to pay the tax on it, you have a small amount, in the Roth that you can pull it out and not have it subject to tax. Again, it just gives you a little bit more flexibility, a little bit more diversification when you are in retirement, if you have that extra Roth money, that extra Roth account. So I just tell a lot of people who, maybe they have 5 years, 10 years, maybe if you're doing a 4% contribution, split it to where it's 2% pre-tax, 2% Roth. It's not all or nothing. You can, do all pre-tax, all Roth, or a combination of both. But good question, Crystal. Thank you.
I have one last question, and then I'll move along. There's no annuities on deferred comp, correct?
Correct. They're all mutual funds. They're institutional share classes. We have both passive, which are index funds, and active, where we have a money manager. A lot of people like, passive index funds. For example, you have, Warren Buffett, one of the richest guys in the world, one of the best investors of a lifetime. He's retiring. His next in line's taking over. Someone asked him, "Hey, Warren, if you had to do it all over again, where would you put your money?" He said, "I put it in an index fund that follows the S&P 500. So the 500 largest companies in the US, we have that. And there's, almost no cost at all to that program. So here's you think the smartest investor in the world is saying, hey, if I had to do it all over again, I'd put it into an index fund." So again, Crystal, to answer your question, they're mutual funds, they're institutional share classes, they're very, very low. So the expenses in our program are as low as you can get. It's one of the largest retirement plans in the country.
Thank you so much.
You're welcome.
I have a question, Peter.
Good, Charmaine.
Hi, how are you? Thank you for such great information. I have a Roth IRA side of what do you call this? Tax deferred. What can I do with that? Can I roll that over into, the city's tax deferred program?
So our plan doesn't allow for individual. We allow for pre-tax rollovers. We allow for Roth rollovers from another plan. Let's say you were in a 401k plan or a 403b. Those you can roll over. But the individual bank IRA, Roth IRAs can't be rolled over. The pre-tax can. I'm not sure the administrative reason why. Even the Roth from a 403b or a 401k can be rolled into our plan, but just the individual Roth IRAs cannot. But it's not a bad idea to do that. The only thing I do tell people who are doing the Roth outside, the deferred comp, almost better to do it inside the deferred comp where you're dollar cost averaging each paycheck going into it,
Yeah. I think I'll follow up with you with an email. I'd like to explore this a little bit more.
Yeah. So if
Um,
you send me an email,
yeah,
Charmaine, I'll
yes,
respond back. On the
yes.
bottom for anyone, Talon
Thank,
has this. I on below my signature is a way where you can view my calendar and book an
okay,
appointment, and I can meet with you one-on-one at your convenience.
absolutely. Thank you so much. Have a great
You're
day.
welcome. Yep, you too.
Peter, there's a question in the Q&A that says, can you roll over from a regular 401k to a Roth? Are there any taxes with such a transfer?
So you can roll over pre-tax and Roth accounts to another program, whether it's another 401k or like a program like ours. What you typically do though is you tell the previous provider that they do it in two checks. They'll send either a check for the pre-tax amount or a check for the Roth amount, and this way they're deposited into the right accounts. Or sometimes they'll do it as a ratio. So if you have a $10,000 account, half the money is pre-tax, half is Roth. We'll then put $5,000 pre-tax, $5,000 Roth when that comes over. I did one recently for myself, and I got from Fidelity, and I got two checks sent to me. One that was a pre-tax amount that I wanted to roll over, and the other was the Roth. So really depends on who the provider is, whether it's Fidelity, Vanguard, Voya, wherever that money is, figuring out how they, from a back office standpoint, how they do that.
Thank you. Thank you
Well,
so much, Peter. I think we got all the questions that were directed to you. There's still
great.
some questions for NYCERS, but thank you so much for your time and expertise.
Thank
It's
you.
much appreciated. And if
I
anyone
appreciate it,
needs to get in
Talon. Yep.
touch with Peter, I put his phone number in the chat.
Thanks, everybody. Have a good day.
Thank you.
thank you.
Our next presenter is Diane Palumbo from TIAA, who's going to talk about retirement options for those of you who are participating in the tax-deferred annuity, the TIAA tax-deferred annuity. Hi, Diane.
Hi, how are you?
Good. And we can see your screen
Good.
if you're wondering.
Okay, great.
So
Okay.
you can go ahead
Okay,
and
so
begin.
okay. Um, like I said, well, like you said, my name is Diane Palumbo, a financial consultant here at TIAA, and thanks so much for joining today and taking the time to learn more about how income works in retirement. All your life, you're being told, save, save, save. Well, that's great advice when you're working, but when the time comes to retire, the question won't be, how much did I save? It'll be, will you have enough income to cover you for life? And that's what we're going to discuss today. For today's agenda, we're going to outline how to understand your income, create an income strategy, optimize your income, and how to prepare. So step one, understand your income. Let's begin by looking at the different types of retirement income and how they work. First, of course, is Social Security. It provides what we call guaranteed lifetime income, which means once you start taking your benefits, you'll get monthly payments for the rest of your life. That's money you can count on in retirement. Now, some of you may not get Social Security if you're getting state benefits, but for most people, Social Security will be the starting point. The catch is Social Security benefits are not nearly enough to live on for most people. On average, it covers only about 40% of people's income in retirement. As you can see, the percentage goes down the more money you make. So for example, if your career average income is about 55,000, it would cover 38% of that amount in retirement. But if your career average income was at the maximum amount at almost 137,000, it would cover only 25% of that in retirement. Beyond that, the benefit doesn't go up and it would only be less. The other thing about Social Security is the amount of monthly income can be different depending on when you start your benefits. And we'll talk about that a little later. Pensions. Pensions are retirement plans from an employer that also provide guaranteed lifetime income with monthly payments for the rest of your life. Benefits are typically based on years of employment, salary, and other factors. While pensions used to be much more common, the number of employers offering them has declined sharply. After reaching the high in the mid-80s, in recent years, only 7% of retirement plans were employer-provided pensions. And in many cases, they've been replaced by 401k, 403b, or 457b plans, which many of you have today. And of course, some of you may still have a pension in addition to or instead of Social Security, or in addition to a separate retirement account. But the majority of people now have their own retirement accounts. So as I've just said, for most people, your own retirement plan investment might be covering the majority of what you need in retirement. You may also have monthly retirement income from things like a job, a small business, alimony, rental income, but most people will rely on their savings. Retirement plans like 401k, 403b are very flexible. Any money you put in is immediately yours, and you can take the money with you if you leave your job, or you control how much money is invested. Your employer may contribute as well, and there's great opportunity for growth on your savings, especially when you start saving early and get the benefits of compounding that could really multiply your savings over time. The flip side, of course, is that there's also risk. Since your savings is invested in financial markets, and we all know how nerve-wracking it is when the markets drop. In retirement, there are no guarantees that your savings will last a lifetime, especially since you don't know how long you're going to live. And since you have to manage your investments until you need the money and decide how you'll pay yourself in retirement, and if you're like many people, you might not feel confident about how to do this. Now, there are many investment solutions that can help manage your investments, and retirement providers can help you figure out how to withdraw your money to make it last. But having enough money in retirement is still a question many people, especially when you're looking at less than half of your income being guaranteed through Social Security. And that's where another option for retirement income comes in. A fixed annuity can help close the guaranteed lifetime income. It's a savings option that doesn't go down in value, isn't tied to the market's ups and downs of the market, and is guaranteed to grow while you're saving. And it could provide guaranteed lifetime retirement check. Having an extra source of guaranteed income in your financial mix may give you a greater peace of mind to know that more of your expenses later will be covered no matter what. And of course, annuities are not new. They've been around for a long time. We've been providing them here at TIAA for more than 100 years. And in fact, many of you already are saving in annuities. But since 2019, when Congress passed legislation that made it easier for employers to offer annuities as part of their retirement plans, the popularity of annuities has been growing. In fact, the TIAA has helped lead the change because we understand the value of guaranteed income for life. It provides greater security in retirement that many people are looking at today. So while TIAA customers have seen the benefits over a lifetime of income from annuities, more and more retirement professionals are encouraging people to include them in their mix. Now, it's important to remember that you still have to save for this opportunity for guaranteed retirement income. And how does it work? If a fixed annuity is available in your retirement plan, consider putting some of your contributions into an annuity as well as in other investments. And most TIAA retirement plans offer this as an option along with your other investments. And like I said, you may already be doing this. And if your retirement plan doesn't offer a fixed annuity, you can buy one from a bank, insurance companies, a lot like what you would do if you were to buy a mutual fund or a CD. You may also be able to get a fixed annuity through an individual retirement account. TIAA IRAs, for example, do offer this. So once you have your money going in, your savings is guaranteed to grow every day, no matter what happens in the market, as I mentioned. Then, when you're ready to retire, you can take out some or all of your fixed annuity savings and annuitize it, which simply means convert it into guaranteed monthly retirement checks that last for the rest of your life. So now let's look at a quick example so you can see how it works. Let's imagine twin sisters, Tara and Rachel. They both are retiring at age 65. Tara takes $100,000 of her savings and converts it to a guaranteed lifetime income through a fixed annuity. Rachel, on the other hand, decides to keep her $100,000 and take withdrawals. This example is based on an interest rate of 5.5%. So, Tara, her lifetime income payment comes out to be about $633 a month, $7,600 a year. Rachel, she wants the same amount of income, but she wants to keep her $100,000, so she decides to withdraw $76 annually. That withdrawal rate of about 7.6. If the interest rate, assuming, is 5.15%. So that means that she's taking out more than what she's earning. And she's taking out more than the 4% withdrawal rate, and which is a common rule of thumb. Hold on, sorry about that. So at this rate, Rachel's account balance runs out when she's 87 years old, while Tara's income will continue for as long as she lives. This is an example. It's based on a fixed annuity, a TIAA's fixed annuity, while it's hypothetical and not a guarantee of any certain payout. It just illustrates the strength PIAA's fixed annuity. And we've been able to offer higher rates because of the large number of people in our annuity and the nature of our investments. And it takes advantage of the pooled risk for long-term sustainability. So you're not taking the risk on alone. So let's just talk about variable annuities. So in addition to fixed annuities, there's also variable annuities. Just like with a fixed annuity, you can contribute to a variable annuity along with other investments. And when you retire and annuitize your money, it can provide monthly income for the rest of your life. The difference is that it takes advantage of the growth opportunities in the financial markets. So while you're saving, your returns will depend on the market performance. The advantage is that you don't have to manage the investments. And then when you retire, your monthly amount you receive is not fixed. It's also variable, and it'll rise and fall depending on how the underlying investments perform. However, your variable monthly income will not run out. You'll still receive income for the rest of your life, even if the amount you converted to the lifetime income would have otherwise run out. So choosing a variable annuity is not an either-or decision. It's a great strategy to pair a fixed annuity, which is rock solid, steady income for life, along with a variable annuity so that you could help offset inflation. So step 2, creating an income strategy for your retirement. First, it's important to understand that there are unique risks in retirement that you need to prepare for, and you may need a combination of those different income sources to address them, since different types of income help with different risks. In other words, in the same way that you might want to have a diversified mix of investments for your retirement to help manage the risks of investment, you may also want to have a diversified mix of income. So now let's just look at what some of those risks are. Longevity. Retirement could last a long time, up to 30 years. Among 67-year-old couples, the likelihood that at least one partner will live till age 90 is 51%. And it's nowadays more and more people are actually living to the age of 100. So that means that your retirement income needs to last. The next is market volatility. As you know, investing involves risk. And while overall markets have historically continued to go up, the timing of the inevitable drops can make a difference, especially if you're early in your retirement years. Overall, there is a 1 in 4 chance of loss in any given year, and guaranteed sources of income can help offset that risk. And then there's inflation. It's another risk. As prices go up, the buying power of your income, which is often steady in retirement, goes down. In the last 20 years, inflation has varied from negative 0.4% to 8%. That's a big range. And in the 1970s, inflation was even higher, peaking at more than 13% in 1980. So basically, for this risk, having income that provides the opportunity for growth can help ensure you'll have enough money when the prices rise. And finally, the one that no one likes to talk about is cognitive decline. This is a risk because it threatens your ability to manage your own finances effectively. and if it begin even earlier than you may think. In fact, 10 to 20% of people over the age of 65 are at least mildly impaired. Income that provides automatic payments for life with no money to manage help address this risk. So now let's see what that means for your income if we look at the likely sources of income for most people, which is going to be Social Security. At 40% of average, and your retirement plan of investments, which generally make up the rest of your income. Social Security, which is guaranteed money that gives you steady monthly income for life, does a pretty good job of addressing all the retirement risks. It lasts as long as you live. The amount you get will not go down, even if the market drops. It includes some adjustments for inflation, and it pays you automatically so you don't have to manage anything if you experience cognitive decline. Of course, this income is less than half of what you'll need in retirement. On the other side, your retirement investments provide important growth opportunities for fighting inflation, but they don't address the longevity risk and the market risk, or the risk of cognitive decline, since many of you have to manage your money yourself. To help diversify your income to more fully address retirement risks, one option is to add a stabilizing feature of fixed and variable annuities. This switches the foundation of your retirement income from being based primarily on sources that may not last you for life to sources that last you for a lifetime. This also helps ensure that you have enough money to cover essential everyday expenses. And that could be a big difference when you're talking about living into your 90s or even 100, as some of you may. If you can or already have been saving in annuities during your working years, you can convert some of them all into savings to lifetime income when you retire. But if you're close to retirement and don't have any annuities in your mix yet, or maybe not even enough annuity savings, you can purchase annuity income with some of your savings. The amount of retirement savings that people convert varies. Some people use 33 to 40% of total retirement savings as a rule of thumb. So you'll have about 2/3 of your total retirement income from lifetime sources. Please remember that this is just an example, and you should decide what makes the best sense for you and your situation. So here, as you can see, how diversifying your income can help check all the boxes when it comes to addressing retirement risk and creating a more secure retirement. And as I've said before, it's really no different than the way you diversify your investments. Beyond Social Security, your retirement investments can give you growth, opportunity to cover extras, and want the extra needs and wants beyond the essentials to help address the inflation risk. Also, annuities help cover risks of longevity and cognitive decline because the income is automatic and lasts the rest of your life. So a fixed annuity addresses the market volatility with steady income, whereas a variable annuity offers growth opportunity to fight inflation. And as you can see, we're not suggesting you turn your entire savings into lifetime income from annuities. That's because you'll need the benefits of broader diversification to help address all of your needs. So step 3, optimizing your income. Let's talk about how to get the most from each part of your income. With Social Security, the amount of money you get depends on when you claim your benefits, and that difference can be a lot. Your benefits become available, one example. The earliest you can claim your Social Security is age 62, but the benefits are reduced 30% compared to what you would receive at your full retirement age. Your full benefits become available at age 66 to 67. It depends on when you were born. If you were born between 1943 and 1959, your full retirement age is sometime during your 66th birthday. For those born in 1960 or after, the full retirement age is 67. For every year you delay taking Social Security, from there up to age 70, which is the latest you can start taking the benefits, your benefits will increase 8% each year. And that's the difference between starting at 62 with reduced benefits and waiting until age 70 with increased benefits as much as 77%. So it's worth considering if you could wait, if you can. So I'll give you an example. If your full Social Security benefits, which are based on your highest 35 earning years, is $2,000 a month, you would only get $1,400 a month at age 62, but you would get $2,480 a month at your full retirement age, which is $1,080 more than you would get at age 62. And like I said, these are examples. And if you go to ssa.gov, you can get an estimate of what your actual benefits may look like. So when it comes to investing and withdrawing your retirement accounts, it's common to follow the 4% rule. It simply means that you withdraw no more than 4% of your investments each year in retirement to preserve the balance so you'll have it for many years. If you want to keep pace with inflation, you can adjust your withdrawals annually, either by setting a flat increase or basing it on actual inflation rates. So when markets go up, the 4% withdrawal can be more than what you actually need. So you can consider taking only what you need, which help offset the years when the markets go down. Also to note, with any pre-tax accounts you may have, the IRS requires you to start taking RMDs, required minimum distributions, when you turn 73 and pay taxes on that money. You don't want to miss any of those deadlines because there's a 25% penalty on RMDs if you don't take it on time. So how can you optimize income with annuities? Some annuities, like the ones we have here at TIAA, give you the flexibility to continue monthly income to beneficiaries if you pass away. This is something many people don't know. It's a common myth with annuities that if you pass away, you lose the rest of your money. And that's not always the case. With annuities like ours, you have several options. You can set them up just for yourself, which offer the highest payout because it's only covering you. You can set them up to cover you, your spouse or partner, or you and other beneficiaries. Having annuities may also help you optimize your income in retirement by allowing you to delay taking Social Security earlier. In other words, if you have enough retirement income to cover expenses through annuities, you may be able to wait to take your Social Security benefits. which would result in higher monthly income. Step 4, prepare now. So now that you've seen how income works in retirement, I hope you'll take the next step by preparing now. Here's what you need to do that can help you get ready. You can save more money, create a spending plan, and review your investments periodically. It's important to check on your investments to make sure your investment mix is properly diversified and still in line with your current age and goals. This helps manage risk while taking advantage of your growth opportunities. The online tool is at TIAA.org/advice-now. Finally, there's no substitute for talking to a professional about your personal goals and needs. If you have a TIAA account, you can call one of these numbers or schedule a call at TIAA.org/schedule now, or you could scan the QR code to go straight there. TIAA financial consultants can talk you through all of your income options and help you with your retirement planning at no extra cost. Thanks so much for joining today, and I hope this has been helpful to you. You could scan the QR codes if you want to learn more, or just watch one of our webinars on a broad range of topics. There's a lot of great information available to you. Thanks again for your time.
Thank you, Diane. There's a couple of
Thanks.
questions. I don't know, I don't fully understand the question, but is it possible to put TIAA annuity into a Medicaid trust? I don't know what a Medicaid
Honestly,
trust is.
yeah, honestly, I don't know the answer to that question, but what
But Crystal,
what I do suggest, yeah.
maybe Crystal can unmute herself and explain what she means by that question.
Sure. There's
Okay.
a big problem in the United States today with
We
health.
can't hear you, Crystal.
Oh, I'm so sorry. Can you hear me now?
Yes, a little bit.
Okay, I apologize. There's a very big problem in the United States today when it comes to long-term care. So some of us were smart enough to buy long-term care before CUNY got rid of it. I delayed, and I didn't do it. So now that means my long-term care would either be out of pocket or through Medicaid. And to plan for that, I'm so sorry, something like this, I would like to have my payouts go into a Medicaid trust so that Medicaid would only see a certain amount of money coming in. That's why I asked that. This is a really
Okay.
big, and you really don't become aware of it until either you get sick or you're taking care of someone who's sick or you're taking care of someone who's elderly. That's when it occurs to you that this is a gigantic problem.
So you're asking if you can put the money in a trust and still qualify for Medicaid?
No, don't worry about that. The second half of that, Taylor.
Oh, okay.
I'm just trying to figure out with these annuities when the payment comes, however I want it, whether it's monthly or lump sum, can it go into a Medicaid trust? And then I can pay my bills from there.
You know, that's a great question. And it probably depends on your individual circumstances. So that's when I would recommend reaching out and speaking to a financial consultant one-on-one just to review. And
Yeah.
that is a really great question, though.
Yeah, because
And also, Crystal asked if a nonprofit organization can be her beneficiary.
I believe so.
Yeah.
Oh, yeah, actually, yes.
thank you.
Yep, absolutely. You're
What is the
welcome.
highest rate on FIA? Charmaine, what is
FIA?
FIA?
Index annuity.
Oh,
Oh, okay. So for a fixed annuity, it all depends. There's not one set number. It depends on when you start investing. So just say arbitrarily it would be, and like I said, example, 4%. Many times, throughout the years, TIAA would, give an extra few percentage, just say to 6%. And then depending on how long you've been invested in the annuity, there's something called loyalty points that you would be entitled to. But the way it works is it's all on a formula. So it depends on when you start putting money into the annuity that you would have a set rate, but it is a guaranteed rate of return.
The reason why I ask is because my husband has with a private company, FIA, and they gave him 19%. And we were like, oh, this is great. This is why I asked, what's the highest rate?
Okay, well, he could have, I mean, I don't know what he has, but he could have a variable annuity combined with that, which would offer more growth. But basically, you would probably just go to his plan and they would have a whole breakdown of each year how much interest he would have gotten or gets.
Thank you so much, Diane. Wonderful
Okay,
information.
that's a great question.
Thank you.
Thank you. Any other questions?
I think that is it. And since we have you for another almost hour, 50 minutes, I think you can. So everybody, Diane is also going to do the estate planning presentation. So you could begin that portion now if you'd like.
Okay. All right, let me get started on that and set up rather.
A. Jackson, she said she sent, A. Jackson sent a direct question to Diane, but maybe you can unmute yourself and ask it because she's doing the second presentation, won't be able to respond to the questions. So do you want to ask it, unmute yourself and ask it? A. Jackson, one. Okay, she'll come back. They'll come back to it later. Okay, you can proceed.
Okay. 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 So everyone could see that too, right?
Yes.
Okay, perfect. Hello, everyone. Again, my name is Diane Palumbo. Today, we're going to discuss estate planning for everyone. It'll encompass wills, trusts, and other essentials. So let's get started. So on this, today we'll discuss 5 main things. Number 1, naming your beneficiary, setting up legal protections, creating a will, and understanding trusts. And then we're going to put your plan into action. Before that, we're going to discuss why an estate plan is so important. Everyone needs an estate plan. Basically, an estate plan is a collection of legal documents that outline how your personal affairs, including your assets, financial, and medical decisions, and the care of dependents should be handled at the end of your life, or if you become incapacitated. Well, no one likes to think about that, especially something sudden or unexpected. Having an estate plan is a standard financial practice that gives you control over what happens to your family and your assets. With an estate plan, many of those decisions will be made by a court, not by you. The court will have to make these decisions in a probate court. Probate is the legal process that happens after someone dies to make sure that their will, if they have one, is valid, their debts are paid, dependents are taken care of, conflicts are resolved, and the remaining property is distributed to the right people. If an estate is simple and straightforward, assuming all documents are in order, there are no disputes or conflicts. The court's involvement may be minimal, but if anything is unclear or if there are any disputes, the judge will be the one to make the final determinations. The probate process can be slow and expensive. Probate often involves court fees, attorney costs, administration expenses that reduce the amount that is left for the loved ones. Court backlogs, missing paperwork, creditor claims, family disputes, and other issues can lengthen the process for months and even years. In addition, poor planning can trigger unnecessary taxes or cause assets to be distributed in a less tax-efficient manner. So here are 3 big benefits of putting an estate plan in place as soon as possible. It ensures that your wishes are known and carried out, helps avoid the delays and cost and possible conflicts of probate, and it potentially shields your assets from certain taxes. As I mentioned before, an estate plan is made up primarily of legal documents. The most common include power of attorney, healthcare directives, a will, and trusts. The first piece of your estate doesn't require a lawyer or any complicated documents, and you can do it right now. The first part is naming your beneficiaries. One goal of estate planning is to make sure that your wishes are clear and simple. Naming your beneficiaries to your financial accounts is one way to do that. Naming your beneficiaries allow your financial assets to be passed directly on to others without being in part of a will or going through probate. You should name beneficiaries for everything, like retirement accounts, life insurance policies, and bank accounts. Basically, naming beneficiaries is very easy to do. Often you could do it online, so be sure to sign up for online access to your accounts. Beneficiary information is often part of your profile, your account profile. But if it's not, just simply search the sites on how to name a beneficiary. And you'll need to do this for every account or policy you have, since beneficiaries only apply to specific accounts on which they're listed. Typically, all you need is the beneficiary's full name adding their address, phone number, or email address could also be helpful. You can decide on whether to name just one beneficiary or more than one. For example, you could split your account between several children, giving each a percentage. And a beneficiary does not have to be a person. It could also be an organization like a charity that you can split the assets between beneficiaries any way you'd like. By the way, there's also a YouTube video naming beneficiaries that you could use if you want to scan the QR code on the screen. While it's important to carefully consider who to name as a beneficiary, it's important not to wait. All your accounts and policies should have beneficiaries listed. Don't leave them blank. This is the fastest way to get assets to someone who may need them if you're not around. Otherwise, it's a waiting game with probate, and those assets are inaccessible until the process is complete. That could take months or even years, depending on how complex or your case is or the circumstances surrounding it. Another thing I would like to point out is, did you know that not even your spouse or partner will have immediate access to your retirement assets or insurance proceeds if you haven't named them as a beneficiary? There's really no reason not to take the first step right away. Review beneficiary changes after life changes. Because it's simple to name beneficiaries, it's also simple to forget about them. Whenever you have a life change, a marriage, divorce, new child, death of a family member, or even a falling out with someone, make sure you check the beneficiaries that you've listed on all of your accounts to avoid any mistakes, such as leaving an ex-spouse an account that you want to go to a new spouse or partner. In fact, I recommend that you double check your beneficiaries once a year, just for good measure. Put it in your calendar, around your birthday, just whatever works for you. Many financial providers also allow you to name a trusted contact to your accounts. This is another thing that you should add to your account profile. A trusted contact is simply someone who can be contacted if your financial institution can't be reached and has a question about your welfare or about fraud, like suspicious activity on your account. A trusted contact does not inherit your assets like a beneficiary would. They also do not have access to your accounts, and they cannot transact on them. And they do not have legal control of your finances. Your trusted contact should be someone that you trust completely, like a close family member, a friend, or an attorney, who could speak on your behalf to help answer questions if the needs arise. And they must be at least 18 years old. Step 2, setting up legal protections. Now let's look at several more relatively easy pieces of the estate puzzle that can be just as important as naming the beneficiaries and trusted contacts. These involve simple forms that you can complete to make sure the right people have access to critical information about you and the power to make decisions on your behalf if you're not able to. Assign a financial power of attorney. This document ensures that if something unexpected happens, like an accident or an illness, someone you trust can step up and manage your financial affairs. Without this document, someone might have to go to court just to help you pay your bills or get access to accounts. It's important that this document clearly state that it's a durable power of attorney, which means that it'll stay valid until you become incapacitated or can't manage your own affairs. Otherwise, it might not be valid if you become incapacitated. That's because there are other types of power of attorney that grant someone the legal authority to act on your behalf in limited ways for a period of time for various reasons. But those documents could end if you become incapacitated. So again, be sure the power of attorney is durable. You can also choose whether your durable power of attorney starts immediately, right after you sign the document, or it's only when you're unable to make decisions. In terms of who you assign to be your power of attorney, the key is select someone responsible and reliable, and make sure that they know where to find your financial documents and how to access your accounts. In addition to financial power of attorney, it's important to have a healthcare power of attorney. This names a person who could make medical decisions for you if you're unable to communicate. This could involve treatments, surgeries, or care settings. It's vital that the person you choose understands your beliefs, values, and wishes. And you've discussed this openly with them, so everyone's on the same page. Again, you could find your state's specific legal form on its government website or get one from a lawyer. Typically, you can select or indicate when the power of attorney goes into effect, whether it's immediately or only if you can't make your own decisions. You don't necessarily need a lawyer for this document, but if you have a complex situation or want to have it customized, getting legal help may be a good idea. Depending on your state's requirement, you may need 1 or 2 witnesses and a notarization when you sign it. Give copies to your agent or primary doctor. Keep one in a safe place, like your other advance directives. Take one when you're admitted into a hospital if you need it. So just always have one on hand. While the healthcare power of attorney gives someone the right to make decisions on your behalf, a living will is a healthcare directive that spells out your personal preferences for medical treatments or interventions. A living will is different than a traditional last will and testament, which I'll talk about in the next section. A living will only addresses health questions. For example, do you want to remain on life support? If recovery is unlikely, these choices can be extremely emotional for families. So documenting your preferences in a living will helps prevent disagreement and ensures that your wishes are respected. To create a living will, use a state-approved form or template to clearly state your wishes. While you may use a lawyer to help create and review it, you can also do it yourself. Follow your state rules about witnesses required when you sign and whether the document needs to be notarized, and give copies to your doctors, families, healthcare agents to ensure that your wishes are followed. A HIPAA authorization is a simple form that allows doctors and hospitals to share medical information with people you designate. HIPAA stands for Health Insurance Portability and Accountability Act. It's a federal law that protects your health information from being disclosed without consent. Let's say you have an adult child who's in college. Unless you have a HIPAA authorization on file, HIPAA laws will prevent doctors from discussing your adult child's health issues, even if they're in an accident or came down with an illness. This is also true of your parents' information and your own information. To obtain a HIPAA release form, you can request one directly from your healthcare provider. You could also find HIPAA release forms online at the web address shown on the screen. Actually, I don't think there is a web address at HIPAAjournal.com. Organ donation. They're another way to clarify your wishes around an emotionally charged situation. If you want to donate your organs, sign up online through your state registry or in person at your local motor vehicle department. If you have an iPhone, you can use the Health app, which sends the information to a national computer system. Most states let you choose which organs and tissues you want to donate. And once you're registered, you can change your information or preferences at any time. Anyone over the age of 18 can sign up. And in some states, people younger than 18, sometimes 15 to 17, can even sign up. To prevent conflict and help ensure your wishes are carried out, it's important to discuss your decision with your family beforehand. Medical teams will typically contact your family to confirm the decision and discuss the process. If everyone is aware of the decisions you've made, it may be easier for them to support your choice. While your family cannot override your decision, family distress may be taken into account in the final decision. While all of these documents can be difficult to discuss, remember the goal is to protect your wishes and see that they're carried out the way you want them to be. Having these legal directives in place also relieves a tremendous burden of people who'll have to carry them out and removes the guesswork of knowing what you wanted. So part 3, creating a will. Now that you have your beneficiaries named and your legal directives in place, what about the rest of your assets, like your house, car, prized collection of valuables? What about a guardianship of your children and even caregivers for your pets? This is where your will come in. The will I'm referring to here is your last will and testament, not to be confused with the living will that I just talked about, since they're altogether different. This document says who gets what, including guardianship of your children. It's the document at the center of many movies and TV dramas. Family members are sitting anxiously in the courtroom or lawyer's office while the will is being opened. Billy, you're getting the ranch. Johnny, you're getting the dog. And then chaos ensues. A will should actually make things easier for others to know what you want and have that carried out. Of course, a will can be challenged, but most are uncontested. Your last will and testament goes through probate and directs the court as to your wishes, with the judge making the final determinations. And one thing it does not do is override the transfer of assets to the beneficiaries once you've named them in your financial accounts. So in those cases, your will not be the last word. And as I said before, that's why it's so important to keep those beneficiary designations up to date. In most circumstances, you'll probably want to work with a lawyer who specializes in estate planning to set up your will. You can address your needs with personalized advice for your situation, though that does come at higher costs. Those costs can vary widely, so check your local estate planning lawyers. There's also reputable online services available if you have a particularly simple situation. Those come with lower fees in exchange for less personalized options. Though they vary in the features and levels of services available, some of them are called Besides Free Will, which help you create a will for free. Some low-cost options include Trust and Will, LegalZoom, Good Trust, Rocket Lawyer, and many, many more. Each offer different strengths like the ease of use, attorney access, and affordability. TIAA does not endorse any of them in any particular order. It's up to you to evaluate each one and decide what's right for your situation. If you have a dedicated financial advisor with TIAA, you can request a referral link for discount pricing on services with trust and wills. The most important thing is to ensure that the language used in your will is legally valid in your state and that it's properly executed, meaning signed and witnessed if required, and that everything you wanted is included. Consulting an attorney for complex situations is always recommended for personalized advice. The process of preparing a will is pretty straightforward. First, make a list of all your assets. Then choose the beneficiaries. If you have minor children or dependents, you'll want to name guardians. This is the person who will be responsible for their care. You could also name someone else to manage finances for them until they're older. The last one is set distribution rules on how your assets will be handed out. For example, you can state that children don't receive them until a particular age. Also, choose an executor, a person who's named in the will to manage and settle your affairs. The executor is responsible for carrying out the will's instructions, paying debt, filing taxes, and distributing the remaining assets to the beneficiaries, often under court supervision. Your executor should be someone that you trust to be responsible, impartial, and thorough. This can be a family member, a friend, or a professional like a lawyer. Once all of this is decided, put everything in writing. You'll sign the will, usually in the presence of two witnesses who are not beneficiaries. Although you're not required to notarize your will in any state except Louisiana, having your will notarized may prevent witnesses from having to appear in probate to confirm that it's authentic and may reduce the possible questions later. When your will is complete, it should be put away for safekeeping in a place your executor will have access to. Like with your named beneficiaries, it's a good idea to review your will every now and then to make sure everything reflects your current wishes. Remember, estate planning is all about protecting the people you care about and making the process of taking over your affairs as simple as possible. Your will is a big part of that. For most people, a will may be all you need to distribute your assets the way you want, whether you have a lot or a little. However, if you do have a larger estate, or have complex specific needs, you may want to consider a trust. Part 4, understanding trusts. While most people do not need a trust, it's beneficial to understand what they are and how they work. A trust allows you to retain more control over your assets than a will alone. Think of it as a container that holds your assets, like a home, investments, life insurance, with instructions exactly how those assets are to be used, both during your life and after. Assets in a trust avoid probate, keeping your affairs private, while helping you set clear terms for supporting your heirs. If you don't need to set up guardians for your dependents, or a trust can replace the need for a will. But more often it works in tandem with a will. Only a will can establish guardians for your children, and the will provides backup for anything not put into the trust. Now, there are many types of trusts that can help with different things. All trusts have a trustee. That's the person or institution legally appointed to manage assets and otherwise administer the trust according to the rules created for it. Revocable. It's the most common. A revocable trust. You keep control of the assets in the trust during your lifetime. They're still part of the estate for tax purposes, and you can make changes at any time. It's often used to pass assets quickly to beneficiaries according to more specific terms other than direct transfers to maintain privacy and continuity. The next is irrevocable. With this trust, you give up control of the assets during your lifetime. They are no longer part of your estate, and you typically cannot make any changes. It's often used to protect assets from creditors and lawsuits and to lower estate taxes. Testamentary trust. Assets are transferred to the trust after your death as part of probate and are distributed according to specific instructions on how they should be used. Special needs trusts are more expensive. It's a more expensive option in which the assets in the trust are not part of your beneficiary's estate and is managed by a third party. That does not affect your eligibility for government benefits. These are trusts used to financially support a disabled child, to pay for uncovered expenses, and protects assets from creditors. Charitable. Assets are tax exempt, and a trust can provide benefits to you or a beneficiary as well as the charity. Deciding if you need a trust and which type may be best for you depends on your circumstances and goals. Here are some questions that you could ask yourself. Do you have a sizable and complex assets? Do you want to control how and when your assets will be distributed? Do you have beneficiaries that may struggle? Do you need to support someone disabled? Do you have estate taxes that could be an issue? Are you comfortable with the costs? You could also check out an article on 6 signs if you need a trust. I'll put the QR code here. The important thing to do is to know, along with naming your beneficiaries, setting up your power of attorney and health directives, and creating a will, a trust can be a key part of an estate plan with its own unique protections and benefits. If you decide to set up a trust, You'll typically work with an estate planning specialist or attorney to prepare the legal document that includes your instructions, trustee powers and duties, management guidelines for minors or special needs, beneficiaries, and tax asset protection language. Next, you'll fund the trust. With real estate, bank and investment accounts, business ownership interests, life insurance, or retirement assets. Once that's done, you'll sign and notarize the paperwork. Some states require witnesses. Your estate planning specialist will ensure compliance. Depending on the trust, you may need to maintain and update it as needed over time. So you have to make sure that it's updated as needed over time. Step 5, putting your plan into action. Now that you have a better idea of what estate planning is all about, where do you start? I've given you a lot to think about here, so let's review and look at how you could put your estate plan into place. While you don't need to do everything all at once, my advice is to get started now with a do-it-yourself item and complete them as soon as possible. The first, name your beneficiary. Set up financial and health powers of attorney. Sign HIPAA and organ donor forms. Consider a living will, also known as a healthcare directive. Next, create a will that's legally sound, not just words jotted on a piece of paper without a signature, hidden in the couch somewhere. If you don't have a will in place that designates who gets what or who should become guardianship of any children or dependents, those decisions will be made by the courts. While the courts generally try to make fair judgments and do what's in the best interest of your heirs, their decisions may not match what you intended. And working with a lawyer to set up a will can be beneficial, but you could also look into reputable, free, and low-cost online services. Start with the basic will, which makes your wishes clear. It doesn't have to include every little detail about who gets each knick-knack. It can, for example, just say who gets the home, who takes care of the kids. Then you could deal with the rest when you have time. And the important thing is make sure you use simple language. Most people don't need a trust, and setting one up is more costly and time-consuming than the other parts of an estate plan. But in some situations, a trust may be a good way to help gain more control over larger, complex issues. And a trust could help keep finances private, provide for someone with special needs, control how and when inheritance is distributed, potentially reduce estate taxes, and give to charity more tax efficiently. Finally, there's some tried and true steps that you can take to make your estate plan a success. Make sure your beneficiary and simple legal documents are always up to date. If you've gotten married or divorced or came into an inheritance, your beneficiaries may need to change. Don't forget to share your documents and information. Everything is likely to go more smoothly if your beneficiaries, trustees, and others clearly understand your wishes. Estate planning is not a one and done exercise. As your life evolves, your estate plan should evolve with you. Whether you're raising a family, accumulating assets, or planning your legacy, it's important to always reevaluate your planning based on your current needs. And I guarantee they'll change over time. Also, start planning now. The biggest estate planning mistake is not to do anything at all. You'll be surprised at how many people don't even have their beneficiaries named on their accounts. Leaving these decisions to chance can increase the likelihood of unintended consequences and costly errors. They may be left guessing and fighting over decisions about your finances, your health, or even your collectibles. Taking the steps to put an estate plan into place can give you and your loved ones peace of mind, knowing that important life decisions are already made and the legacy you leave is the one you wanted. What we've covered today, it's a lot. It's just an introduction to estate planning, but I hope I gave you a little more of a starting point and motivation to create your estate plan. Many steps are relatively quick and easy, so don't wait. And if you have a TIAA account, schedule a call with a financial consultant. You can go online or scan the QR code, TIAA.org/schedule now, and it could help you with a host of financial planning needs and point you in the more estate planning resources. Please check out our other learning resources online at TIAA.org/learn, as well as other webinars at TIAA.org/webinars. They're free and available to everyone. Thanks everyone for joining. Does anyone have any other questions?
Thank you, Diane.
Thank you.
Can we get a copy of these slides for distribution?
Oh yeah, absolutely. Yes.
Okay, thank you. Good. Does anyone
Okay.
have a question? You can unmute yourself if you would like. I guess not.
I know. It's a lot of information.
It's a lot, but I think that
Yeah.
if they get a copy of the slides, then at least they'll have something to refer back to. So thank you so
Yeah.
much.
Okay,
Thanks
thank
for your
you.
time and expertise, Diane. Thanks you to everyone who joined today. We
Thank
hope
you.
that you found it to be useful
Yes.
and kind of simplifying the navigation of retirement with CUNY. It can be really complex, but we're here as a resource for you. As always, your benefits officer at your campus should always be your first point of contact if you have questions about planning for your retirement, spending down your sick leave or your annual leave or terminal leave or whatever your options are. Please go to your benefits officer first. But I am always here as a resource for you. And thank you so much for joining today. Have a great week. Have a great week, everybody.
Thank you. Bye.
Bye.